Ladies and gentlemen, things just got far worse and the banking system is flashing code red. We have got new reports, new information to show there is a new trend that's happening in the banking system that's going to cause massive losses for these banks. We've also got other reports of lenders going bankrupt and other bank stocks crashing massively. Not just this, but even some of the biggest names on Wall Street like JP Morgan, Morgan Stanley, and Goldman Sachs are saying that the stock market is severely overvalued and we have a contraction in these equities, while it could lead to margin calls and more losses for the banks. So everyone, you definitely need to pay attention to what's happening right now, because I think we're about to have a repeat of what happened in 2022 when Silicon Valley Bank went bust. So without further ado, you know what time it is. Let's get straight into the news, the facts, and the data. So okay, first things first is this story, everyone. And when I really got into the details of this story, I was shocked with what I found. So it says here, losses from car loan fraud soars above other debt, a new study is shown. And you won't believe how bad it's getting. So the data underscores growing perils in auto lending at a time when two small but high profile bankruptcies in the auto sector have revived concerns about the auto market. And besides the housing market, this is the second largest credit market, especially for the banks. And so if this market sees a huge crash in these subprime loans, well, we're going to see a domino effect across the whole banking sector. So some of the worries focus on how lower income auto loan borrowers are faring, with subprime borrowers falling behind on their car loan payments at record levels. So this is not a small amount of defaults, this is new all-time highs, actually getting to 2008 and 2009 levels. So when auto loans suffer losses, they are dramatically higher than losses in other types of consumer credit. Because listen to this, the average auto loan fraud lost 21 times more than the average credit card fraud. This is according to a credit reporting agency which reviewed performance across a variety of loans 2 years after they were made in 2023. Now, relative to unsecured personal loans, the average loss on each auto loan fraud was 6 times higher, the analysis found. So did you get that, everyone? The average auto loan losses were 21 times higher than credit card fraud and were 6 times higher than personal loans. This is a new alarming trend that is getting far worse and we simply cannot ignore. The higher losses in auto loans are largely because auto loans tend to be bigger than other unsecured personal loans or credit cards. Now, the reason why is because high losses in auto loans are largely because auto loans tend to be bigger than other unsecured personal loans or credit cards. One exception was auto loans tied to the strongest or super prime borrowers, which had higher fraud losses, not just in overall size, but also in percentage terms when compared with credit card and personal loan debt with similar credit scores. And so why is this happening? This should be good credit-worthy borrowers that shouldn't default. Well, the reason? That is in part because fraudsters have found sophisticated ways to gain access to big car loans for super prime borrowers. And this is definitely why you need to take your credit card security and your banking security very seriously. And so how exactly are the fraudsters doing this? Well, TransUnion said one fast-growing tactic fraudsters use is credit card washing, which involves artificially cleaning a person's credit score, for example, by submitting false identity theft claims to enable them to take out bigger loans with lower interest rates. That tactic has grown more popular thanks to social media as users share tricks with one another online. And this has led to more fraud from borrowers with higher credit scores. So okay, things are definitely bad in the auto sector, but how exactly is this affecting banks? That takes us to part 2 of this story. So look at this, everyone. Bank shares lead global market fall amid jitters over US private credit. Signs of credit stress sends markets in Europe and Asia down while investors turn to safe haven assets. So this is starting to have a ripple effect. They're starting to have contagion across the entire global financial system. Because what we learned from 2008 is all these banks are interconnected. So it says here, US banking stocks plunged on Thursday after Zions Bank Corporation, a Utah-based lender, said it would write off $50 million on 2 loans, and the Phoenix-headquartered Western Alliance said it had started legal proceedings over a bad loan said to be worth $100 million. But it doesn't stop there. Shares in Zions plunged by more than 10%, while Western Alliance dropped more than 9%. While this was an isolated story at two banks, each with less than 10 billion market cap, the event drew inevitable comparisons to the regional bank stress that followed the collapse of Silicon Valley Bank in 2023. That raised broader questions over potential credit quality issues after a lengthy period of elevated rates and expansion in private credit. And we're definitely seeing this because what a lot of these banks do is they take all these subprime borrowers, they take all these loans that have bad borrowers, subprime borrowers, mix them with super prime borrowers with good credit scores, and then they sell them off to investors as safe assets, just like they did in 2008. So they're making the exact same mistake. It says here the US regional banking industry has been under scrutiny after First Brands, an auto parts supplier, filed for Chapter 11 bankruptcy in late September over credit concerns. In its bankruptcy filing, First Brand disclosed that it had at least 10 billion to 50 billion in liabilities against 1 to 10 billion in assets, the product of what appeared to be risky off-balance sheet financing. But just wait until the world realizes it's not just a few of these small banks. Richard Hunter, the head of markets at Interactive Investors, said, "There are increasing signs of storm clouds gathering over markets with little relief from the building wall of worry, and it's becoming obvious for everyone to see. Already grappling with stretched stock valuations in the AI space, an unresolved government shutdown, and deteriorating relationship between Beijing and Washington, investors were exposed to a new source of concern in form of lending practices and bad loans for US regional banks." So that takes us to part 3 of this story. We've got new warnings from not just these regional banks, the mega banks, about how overvalued the stock market is and what stock starts to crash, and a lot of these investors that have taken on margin debt at record levels over $1 trillion, we're going to start to see the losses mount up. So look at this report, everyone. Wall Street falls as bank CEOs warn of possible pullback, sparking tech bubble jitters. So US stocks veered sharply lower on Tuesday as big banks warned that equity markets could be headed for a drawdown, reflecting mounting concerns over stretched valuations, which I've been warning for a while now. All 3 major US stock indices slid well into negative territory after CEOs of Morgan Stanley and Goldman Sachs stoked fears of a potential market bubble, with the S&P 500 having climbed to a series of all-time highs, largely powered by the artificial intelligence boom. But the AI industry has been exposed now. We've seen all these companies just simply lending money to each other, saying they're going to buy this, buy that, when it's really just them turning money around in a pot to make it look like their revenue is much higher than it really is, and people are now starting to catch on. It says here, tech shares weighed particularly heavy on the Nasdaq, with 6 of the Magnificent 7 AI-related momentum stocks losing ground on the day. And this is what I've been talking about in my videos recently. It's really the only 7 Mag 7 stocks that are creating this stock market bull run. 80% of the S&P 500 stocks are actually in the negative. Now, JP Morgan CEO Jamie Dimon warned last month there's a heightened risk of significant stock market correction within the next 6 months to 2 years, citing factors including geopolitical tensions, which I think is only about to get worse. And the US government shutdown is about to make it much worse. The US government shutdown, the result of congressional impasses, is nearing the record for the longest ever. The resulting dearth of official government data has led to increased scrutiny of private credit sources such as ADP's National Employment Index expected Wednesday. And the thing is, we're not going to get all this data for how this government shutdown is affecting the economy until Q1 in 2026. So I think it's in Q1 2026 we're going to see the US economy enter recession because the US government is going bankrupt. And all these massive grocery companies, all these grocers like Walmart, all these companies that sell a lot of food, all the big food companies, I think 25% of their revenue actually comes from SNAP coupons. They're going to see big revenue losses, and I think this is going to reflect in their stock valuations, and we're going to see a big correction in Q1 of 2026. So everyone, the banking system is not safe at the moment. We're going to see huge losses for the banks on these auto loans. Once we see a correction in the stock market, people have taken on huge amounts of debt to speculate on the stock market. We're going to see even more losses, and the banking system stability is going to be very, very rocky. So you don't want to make the same mistakes of them. You definitely want to have some liquidity, some cash. You don't want to have huge leverage debt. You want to pay off all bad debt besides your home loan. You want to have an emergency fund and some cash on the sidelines, so when this market does correct, you can go in there and buy assets for pennies on the dollar. And with the dollar continuing to lose purchasing power, you're going to want to have a non-correlated asset, and that is gold and silver. So when the day eventually does come that the US dollar loses world reserve currency status, your wealth will be protected. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.